This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. In this segment, we'll talk about how 10 Capital works and its fundraising program. Happy to tell you about 10 Capital. Don't know if you know us very well or not, but at heart, we're based here in Austin, but we work around the U.S. I actually spent a lot of time in Albuquerque. I've had some companies out there that we've worked with, and then I taught a class at the Los Alamos labs this past year. Once a month, I'd fly out and we would go through a process of how to stand up a business with some of the technologies coming out of the labs. So that was a lot of fun as well. But at heart, we do is run investor relations and introduction campaigns. We take your pitch deck, go out to our network and build a list of interested investors, although it's initially interested. Angel, VC, family office, we have 20,000 on the list. My background is I started 3 angel networks in Texas back in the 2000s. Started CTAN in 2006 and the Baylor Angel Network in 2007 and Wilco in 2008. Started this company under the name Texas Entrepreneurs Network in 2009. So we've been doing it since then, 12, 13 years now. And then we have just kept growing our investor network and our client base to where we're now national. We went national back in 2017 and changed the name to 10 Capital. It stood for the old Texas Entrepreneurs Network. But at the same time, we would work with companies and investors from across the country, and they're all accredited, Angel, VC, family office. And at heart, what we're doing is running investor relations campaign. We're finding investors, telling them about the deal, getting them interest, getting them introduced to you, and then warming them up to come in and be a part of an investment opportunity. All we need to kick off is a pitch deck, but we'll look for a term sheet and a data room or diligence box later in the campaign. If you've already raised money, you probably already have all those things anyway. So we also go to angel groups. If you raise money from one angel group, you can raise money from more. We find a lot of people, especially from the West Coast, East Coast, have never been to Texas Angel Networks, and there's 6 that are fairly good size here that understand the value of what you're doing, and with the wellhead monitoring, that they would be interested in it from that point of view. They do look for revenue, not a lot of revenue, but the fact that you can sell your product and people bought it and they're happy with it. That's what they're looking for. They just want to know that you can sell it, and we're the same way. You don't have to have a lot of revenue, but the presence shows that we're in the market, and that's what we want to present ourselves as, is we're able to sell our product today, even though there's more work to be done on the product for sure. We're a monthly retainer. It's $3,000 a month for a 3-month commitment. And then after that, it goes month to month. We are not a broker. There's no back-end fee. We do not have a FINRA license. I looked at that early on, but found I was going to lose all my angel groups and VC funds because they don't let brokers in the deal. They just, their fund or their angel group bylaws don't allow money to go out for transaction fees. So we went the retainer model, and that works fine for angel groups. It's just marketing is what they look at it as. And I found that the hardest part people had was just getting the introduction and getting the dialogue going. And then once it was going, they were able to close it themselves. So that's how we work and what we do. What questions did you have for me?
What is the overlap between your network and Houston, Dallas, CTAN, all these other Texas Angels? Do you have access to any that they don't have access to?
Well, only 3% of angels are in an angel group. And so at heart, I do have some people that are in CTAN on my list, but primarily I have probably another 2,000 in Austin that are not in CTAN. I just have a much bigger network than the angel groups do. Now, angel groups are worth going to because you have a group of people concentrated on it. You go through the process, you get to the presentation room, you can get anywhere from 3, 4, 500K on the low end to 1.5, 2 on the high end from an angel group, a big angel group like that. Same thing for CTAN. And then there's Baylor's about the same size now. They'll do 500K on a good deal. South Coast, which is in Corpus Christi, there's more like they're in the 20, 25 person range. So it's more like 200-300 that you would get out of those guys. So for those, we're helping you go through the process. For those that are outside, but we do have investors that are outside as well. In fact, the majority of our guys are outside of an angel group. They're just individual angels that write checks. There's some syndicate funds in there as well. There's some micro VC funds that are in there as well. Also, there is a group of investors in Houston that are in the energy transition space. But to be candid, if you have recurring revenue and you're dealing with data and can monetize data, you would find interest from most of those groups anyway, even if we're not true climate tech, or maybe we are part of the climate tech world. If you have a good story around that, that's where they're trying to go, is to have a good story around transition.
What's your motivation to do a really good job if you're working on a retainer? And I'm just asking the question I'm kind of curious.
Well, many of our clients come from other clients. And so if we do a good job, we'll get more clients. So follow-on business is a big factor. On average, our investors after 3 months get about $500K worth of introductions. So we certainly can do that. And we've been doing this angel thing for a while. So I have no problem going out to as many angel groups as we need to run that program, because we've got a good solid system in place there as well. Know about half the guys you're talking about already. The other half we want to know. So that would be it. But so I think our track record, we've been doing this for 12 years. So we've got a pretty solid team in this case. And like I say, just historically, people have come in and have done well with the program when they participate. I have people sign up and then get busy with something else. And 12 weeks comes and goes pretty quick. And if you spend a month getting your deck ready and another month getting out to pitch to somebody, and get another month to go back and call that person back. And I've had that, people calling back 3 months later. You can do that, but after 3 months, you're pretty much starting over. Now, who are you and what are we talking about? So if we're all timely and actively working on it, then we always get a good result. So that's about as good a guarantee as I can put on it at this point.
And roughly, I mean, you've got a lot of clients. I'm sure.
We have 21 clients and we don't take more than 25. So we have 4 slots left open, because there's a lot of white glove treatment on these things, as you can see. So we can only take on so many.
Okay. It's pretty interesting. I wish I'd met you 3 years ago. It's always probably something you hear a lot of, I'm sure. It's
yeah. Where were you 6 months ago? Yeah, well, you're hanging around. In this segment, we talk about the gap between seed, seed plus, and Series A. Please enjoy. VCs, you'll find that at 500K annual run rate, they'll get interested, but at $1 million, they'll start to engage. Till you get to $1 million, it's going to be tough. I will say it is a pretty big gap between the angel and the VC world. We talk about pre-seed, seed, Series A, Series B, but what I witness out there is pre-seed, seed, seed plus, another 250K bridge round, and then Series A, because the institutional standard is going to be pretty high compared to what we've been used to. Now, if you get it, that's great, but most people come back to me for another seed plus and plus because they need a little bit more money to keep going. In one sense, the angels make that easy. If we're on convertible notes, they just keep writing checks. We keep signing the note, and money keeps going into the business. Nobody has to climb the valuation wall or anything like that. So you may find that you may want to budget some seed plus raises in between to keep the growth going, because you want to keep that revenue traction going up, and that usually requires a little bit more money. But you don't really need a full Series A round to do that just yet. And you can start to build a relationship with some of the VCs that are out there. So for when you hit the $1 million revenue run rate recurring, and maybe you're monetizing data that goes on top of that, that's when VCs start to take notice. But they'll take notice of you at 500, but they're really not going to do much until you get to $1 million.
Right. No, I agree with all that. Not my first rodeo or Greg's. We've both done this a fair number of times before. And I think some of the conversations we've had with VCs and their interest is because of us personally, maybe more so than the business. But
if you've got relationships, you can leverage that for sure. And maybe you can get a pre-seed investment from them before they do a true Series A. They like that because they can kind of check out the team and the process before they really commit big to it. If you're asking for big money on the Series A, it's just tough because they have to go call that capital from their family offices and LPs, and that's a very tough phone call today. I will say the market's going in the right direction. I do think at the end of the year, we're going to be finished with these interest rate uncertainty. It's not the fact that they won't keep doing that, but it's going to be much clearer about what they're going to do, and then everybody can kind of factor that into their plans and get back to business. So I think it will be easier next year for sure. But if I'm in your shoes, I'm probably taking the convertible note around for a second round when I finish this one, just to keep the ball rolling, because that can be very handy to have money coming in on every month off the note until you get to the place where you can really do a full Series A.
So you sort of intrigued me a little bit with these intermediate or bridge kind of seed plus. And that would be, in your experience, under the convertible note that had been used previously, and it would just be an extension to that note, or it would be a new note with a different cap, different interest rate? What would that look like?
You can go to your board and have them extend the current note, or you can just finish the current note and start a new note. But typically the valuation is the same. Maybe it goes up a little bit. If I had my choice, and I'd be going to the market with a $2 million raise, but I'm breaking it down into rounds. And the first round is at a very low valuation. You're kind of past that now because that's the hard part. And then the middle one is higher valuation, and the third tranche is even higher. And that we structure it that way to incentivize people to come in early. But if you already have some of the money coming in, then I would just probably stay where you are right now and just keep picking up checks. If we're trying to raise money on a timeline, you can run deadline campaigns if you break it into rounds. So each small piece, like the first 750, when I get to 500, I'm going to start to do a deadline campaign saying we're closing in 6 weeks, who wants to be in, and kind of move people through the queue. That's the hardest part is moving people to make a decision and get on board now versus later. Sometimes you have a big milestone event or sell or what have you, product delivery that gets people to jump forward, but most often you don't. You're just having to move them. And if you can do that with a deadline campaign, that works. But you might think about, when you finish this note, you could do that. You could go to them and say, okay, when you finish the $5 million note, we're going to be going and doing another $2 million raise, but it's going to be at $7 million, and use that as an incentive to come in now, as opposed to later. Because if you don't, otherwise people think, well, I can come in anytime and the price will always be 5. If you kind of tell them otherwise, no, it's going to be going to 7 here pretty soon, then you'll find it a lot easier to close the last 500 of this round. In raising funding, having a due diligence report greatly helps the process of closing additional investors. Always bring up the fact that you have diligence reports available from other investors when closing.
And we do have due diligence from all of those groups. So, those are things that we would certainly probably want to promote better and put in front of people.
Well, that is one strategy. If you went to the Gopher Angels, what we would do is go find out who their syndicate partners are. Sometimes it's geographical. Sometimes it's by sector. We have 15 angel groups that are in the life science space that we go to. And we go to the other groups saying, the Gopher Angels are in. We don't get into the details. We just say they're in. And they got a diligence report available. Would this be of interest to you guys? Yes. Okay, we'll fill out the application, go through, and start working our way through the process. So you can do a networking approach to this, where you're just going to more angel groups and you use the logical affinity that might go in. It's a life science deal, or it's a deal in your state or in your region, and so forth. And so and then we have the diligence report, and we also have diligence reports from these other 3 groups as well. So it starts to show, because the last thing an investor wants to be is the only one in the deal. So if others are in the deal, they've done work and I can get access to that, well, now I'm going to be much more interested in coming through with it. And then having a good solid deck ready to go and so forth for the pitch and all that, going through the screening process, making sure the DLM application or Spark or Gus is up to date and correct. It can be challenging with those platforms because even 3 months later it's out of date dramatically, and so we have to go back and make sure those things are current across the board. And so there's all those things. In closing investors, due diligence can also be done during dinners, which case you can actually invite people out to have a meal and answer any questions they may have. This is a great way to close investors and answer all their questions. Listen to these steps coming up soon. One thing we are getting into is in-person events. We used to do these at the beginning of the campaign. Now we've discovered it's more effective at the end of the campaign. You have 10 guys in, Minneapolis that are saying they're interested, but nobody's doing diligence and nobody's going through it. We go and have a dinner in a nice restaurant in Minneapolis in the private dining room with a big screen, and 2.5, 3 hours, go through and answer every question they have, and then do a close, get about a 30% close rate on those, because we're usually near the end of the campaign anyway, or the round, and we need to close. So here it is, who wants to be in? And a dinner really helps answer it. And it solves that problem of the relationship. We have to build a little bit of relationship along the way. And sometimes if we're calling on the phone every week, we build it. Other times we're doing everything by email and we're not building it. And so we have to get in there, and they have to know who we are before we're going to get their money. And at heart, they kind of want, we want to know who they are too. Who are these guys before we take their money? And so the in-person dinner really helps a lot. The only thing we would charge on that is the food in the room, which is about $3,000 to $4,000, and for a 15-person dinner type thing, nice restaurant downtown. So those are some things we can do. If we look at your list of investors that are expressing interest but not closing, we do that. Working with investors who are not familiar with the due diligence process, one can use the due diligence walkthrough technique to bring the diligence to a close. Here's an example of how it may work. The other approach is with individual angels, we do what's called the due diligence walkthrough. And these are guys who say, yeah, I need to do my diligence, but at heart, they don't really know what that means. They don't quite know how to do that. And so what we're going to do is send them the due diligence box and set up a half-hour call. And we're going to say, we're going to show you where everything is in the diligence box. We're going to walk you through it. And you open up the entity filings, and you can see where Delaware City. You open up the income statement, as you see, we have a growth rate of X, Y, and Z, and the balance sheet has no debt on it and so forth. As you're walking through, they'll ask you questions. What about this? What about that? And you answer it right then and there. They've had these questions all along, but they just never wrote them down. They never ask you. But if you can walk them through the diligence, that will surface questions, you will answer it. And by the time you get to the end, you ask, so what are the questions do you have? Well, no, I think you answered everything. Well, I think at that point, you've done your diligence. I'll send you the wiring instructions. The deadline's in 3 weeks. Hope you can join us. We have $250K left in the round. We have $500K of interest, but it's first come, first serve. Whoever wants to be in can join, no problem. And you then start to close them on that. So I like doing these rounds because you get to run deadline campaigns. And that's really important. If I'm raising $10 million, I really can't run a deadline campaign if I only have $1 million in. But if I break the $10 million down into 3 tranches, 2, 3, and 5, at 1.5 into it, I'm going to be closing that round. You can then go around and effectively sign people up or not and say, now if you don't make it, no problem. Now it will be a higher valuation on the next round, but you don't mind paying more, and see if we can move people through. So those are things we can do as well with the diligence box. Figure out who those guys are when they're one-off investors by themselves. They're not in a big group or anything.
No, this is good stuff. Okay. And then going back to that dinner, again, you guys are organizing all of that, right? As I think about that, it's really not the money that's critical for me. It's more of just getting 10 people in the room, getting 15 people, how do you make sure they're there? And I think that's always a challenge to say it's a great idea right up until people are bailing at the last minute, right? It's hard sometimes to just keep it all together and organized. So you guys do all of that as well, huh?
Yeah, we get everybody in the room. Like I say, I'm finding 2 things that drive people in the room is number one, most people's work is on Zoom like this, and 8 hours of Zoom really gets people interested in an in-person event from time to time. Once a month is pretty good. And 2, they like the nice dinner. They want to get out and have a nice dinner, meet some other people, and do some networking. So that usually helps get people out and watch it. And we're only going to do this once, and then we're closing. As a part of a closing process, it can be helpful. If we're going to do this every month downtown, well, then we kind of lose that effect because they can do it anytime. Yep. So you got to put some scarcity into it a little bit. But we have a team member that actually does that. They mail out to them. We call them up and we explain what it is if they need that, and then we get them in. You will get out of 10, 12 people is what we mostly have been asked for, because there is a cost to the food and room. 2 people from the company, 1 person from 10 in most cases. And then you'll get 1, maybe 2 that drop out at the last minute for whatever reason. We do try to get back in touch with them to close, but that's 10, 15% fallout is a part of it. You can oversubscribe and get 13 in the room if you want. And that's a nice room where you can get around and talk to people. And that's one of the things you need to do is make sure you go and talk to each person individually, because later when you go back to follow up to close, if you've talked to them, they feel like they know you, they're going to be much more likely to take your call than if they were just one in the crowd and we were just broadcasting to everybody at the same time, which is part of it. But building the relationship is one of the key things we're trying to get done. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.